Hey there! Today, we're diving into a topic that seems simple at first glance but actually hides an entire economic universe. We're talking about the spread. In this video, you'll learn how this small number can cost you money, impact your profits, and even determine the outcome of your entire trading strategy. Stick around until the end to make sure you don't lose money on your very first trading move. Give the channel a like and subscribe if you find this useful. Picture this. You just landed in a country you've never been to. In your pocket, a stack of bills in your home currency. You urgently need to exchange them. You walk up to the nearest exchange booth at the airport. The screen says, "We buy at 50, we sell at 60. You hand over 1,000 units of your currency and get 500 in the local money. But if you change your mind and try to exchange it back, you'll only get 833 units. The loss is obvious, and that loss has a name: the spread. That's basically how exchange offices work. They buy cheap, sell higher, and make money on the difference. And this mechanism doesn't just apply to currency. It's the same with stocks, bonds, crypto, even raw materials. Now imagine a situation on the stock market. You're looking at a chart. The stock is trading around 150. You decide to buy, but the order doesn't go through. Why? Because that price you saw was just an estimate. In reality, there are two prices: bid, what buyers are willing to pay, and ask, what sellers want to get. If you want to buy, you'll pay the ask price. If you want to sell, you'll get the bid price. The difference between those two? That's the spread. On active markets, the spread can be just a few cents, but in less liquid markets, it could be tens or even hundreds of points. One key factor that affects the spread is liquidity. The more people are willing to buy and sell at the same time, the tighter the market is and the smaller the spread becomes. When there are tons of orders coming in every second, buyers and sellers compete with each other, and that shrinks the gap between prices. But if the asset isn't liquid, trades are rare, orders are few, and the gap between prices can get huge. That's when the spread jumps, and you, as a trader, become vulnerable. Even if you bought something, selling it back at a decent price might be impossible. Join our Telegram channel. We post updates on new videos and articles there. Links in the description or the top comment. It's super important to understand that the spread isn't just some technical jargon. It's a living, breathing measure of market dynamics. It changes throughout the day depending on trading hours and current events. For example, in the first few minutes after the market opens, things are hectic, orders are scattered, and the spread widens. The same thing happens at the end of the session. Fewer participants, lower activity, and boom, the spread gets bigger. So you buy during that window thinking the price looks fine, but when you go to sell, you're suddenly down 1 or 2% just from the price difference. In other words, the timing of your trade can make or break your profit. Margin trading makes this effect even worse. Imagine you're borrowing money to increase the size of your trade. But because the spread is wide, your entry and exit cost way more. You pay fees, and on top of that, you lose money on the spread. Even if the asset goes up, you might break even or even take a loss. And all because you didn't factor in the size of the spread. It's especially dangerous in fast-paced strategies like scalping or intraday trading. Market makers, the unsung heroes of the trading world. These are firms or pros who commit to constantly posting buy and sell quotes. Their job is to keep the market liquid and smooth out price swings. They earn money from the difference between bid and ask. Thanks to them, you can place trades quickly, even when other participants are inactive. If there's no one on the other side of your order, chances are it's a market maker stepping in. The more of them there are, the more they compete with each other, which means tighter spreads and better conditions for you as a trader. Scalpers and algorithmic traders are especially sensitive to the spread. Their strategies rely on making hundreds of trades a day. Sometimes the profit from a single trade is just a fraction of a percent. In that kind of environment, even a tiny bump in the spread can destroy your entire strategy. That's why pro trading algorithms treat spread as a key parameter and only work with assets that have a consistently narrow spread. Some even hunt for anomalies, moments when the spread jumps, to profit from the snapback. But to pull that off, you need lightning-fast order execution and a deep understanding of how the market works. One of the most common beginner mistakes is ignoring the spread. They open their trading app, see the price, and place a buy or sell order based only on that number. But markets aren't that simple. The order might not get filled, or it might execute at a weird price. The investor gets confused, cancels it, tries again, and ends up losing a bit of money each time. This is especially painful with low liquidity assets, where even a small spread can eat into your return. Beginners blame it on volatility or bad luck, but the real issue is not understanding how the market actually works. There's a new article up on our website. It's full of free content about stocks, bonds, and ETFs, from beginner tips to advanced strategies. Check it out and bookmark the site. Another myth floating around is that zero commissions mean free trading. A lot of brokers promote their platforms as commission-free, but the real cost is hiding in the spread. If the spread is wide, you're still losing money on every trade, even if you don't pay a visible fee. This is especially bad in mobile apps with simple interfaces where you don't even see the bid and ask prices. You click buy, and you get the worst possible price. Then you click sell, and you get the minimum. That money doesn't go to the broker, it goes to the traders on the other side of the spread. The real fees stay hidden unless you really know how the market works. For big investment banks and institutional traders, the spread is a tool. They have access to massive liquidity, they place orders on both sides of the market, and they manage their positions based on how the spread is moving. They use advanced algorithms that track tiny changes in the spread and react instantly. Sometimes they do thousands of trades per second, making money off fractions of a percent. Their advantage? Speed, tech, and capital. They're not just competing with retail traders, they're providing the infrastructure the market depends on. And yes, they lose money too when they misjudge the spread. But most of the time they win because they've turned it into a calculated mathematical risk. Another key factor: how news and macro events impact the spread. When important data is released or a central bank makes an unexpected move, the spread can spike. The reason? Panic, uncertainty, and a sudden drop in liquidity. Traders pull their orders, market makers back off, and participants either stay out or place orders with a lot of buffer. The spread becomes more than a price indicator. It turns into a fear barometer. Even a basic trade can turn into a gamble. Experienced traders either stay away during those times or use them strategically. But either way, they know the spread will go wild and could wipe out any potential profit. Let's not forget about trading sessions. The spread behaves differently depending on the time of day. It's usually the tightest during the middle of the main session, when the market is busy and volume is high. In the morning, right after the open, or in the evening near close, spreads widen. These edge-of-day trades are more likely to go against you, especially if you're trading manually, and if you're using margin, the risks are even higher. That's why pros avoid those time windows and focus not just on charts, but also on the depth of the market. And finally, how the spread affects long-term investing. At first glance, if you're buying something to hold for years, a few points in the spread might not seem like a big deal. But if you're rebalancing regularly, switching between assets, taking profits, that spread slowly chips away at your returns. This matters especially with low liquidity ETFs or corporate bonds, where the spread can be several percent. Over time, it becomes a constant drag. That's why even long-term investors with a 5 to 10-year horizon should factor in the spread, not as a threat, but as a built-in cost that needs to be part of the plan. Give this video a like and subscribe to the channel. Support our work on the membership platform. Links in the description or pinned comment.